People of the internet, welcome to another vlog, and today we are talking about the number one topic on the stock market. Is the recession coming? If yes, what should I do? Should I hold my stocks? Should I sell everything? Should I go in gold or whatever? We're discussing today top 3 things to do during a recession when it comes, so you are totally prepared if you're watching this vlog to the end, because there's some 3 very fundamental things you can do. And make sure, if you are new here, to subscribe and smash that thumbs up button. Let's go. Okay, so number 1 thing to do, and it sounds strange, but just do nothing. If you already invested, then just do nothing. This is top tip number 1 during a recession, and I will tell you why exactly. Because the bear market phase of a stock market historically is much shorter than the bull market phase, and this is in effect that actually you are, if you are going out inside a bear market, then you lose all the gains if the timing goes, the market goes up again, and you never can time the market properly. So have a look in this animation or this video here. You can see that the bear market phases took 1-digit months or even up to 20 months. But if you're looking into the bear market phases, they are much stronger, they are much longer. So you see what you are missing out when you are going out of the market. So just stay inside the market. And the bull markets, you know, the longest bull market ever is already since the 80s intact. And of course there was some downturns, but if you're looking into the big picture, you know, the longest bull market was from the 80s to the 2000s, before the dot-com crash. And you see that the bull market can have even hundreds of months of active phase. So it's better to stay actually inside the market for you. And in the second video that I will show you now, you will see how much actually the stock market you lose during a recession. So have a look on that. So you can see that over the last 50 years or 60, 70 years, the recessions, just some of them was negative, and the markets actually gained during a recession. So you should not be so afraid of a recession, because on historic data, and if you look it down to the number, on average 5% the market gain during a recession time. And even though 2007 was pretty hard, minus 37% for the market, but this was a global crisis, global depression even. And you can see that, you know, you don't have to be scared going into recession, because statistically and historically speaking, a recession, the market still grows. Okay, so basically whatever is also important to know, you know, if we have market sell-off like in this week, you should have seen that the most gains into the stock market are actually the days or the weeks after. So historically speaking, 14 days after a market sell-off, the market gain, and you should take this gain with you. So that's why you should stay in the market, even though you can imagine the stock market like a scale. So once it's going into one direction, it's balanced itself out into the next direction. So you should definitely stay into the market to get these gains, because if you lose these gains, if you are panic now and go out of the market, then you lose these gains. And historically and statistically speaking, these gains are needed to have a properly positive portfolio over the long term, and the long term is definitely the way to go. Let's go to top 2. Number 2 is buy in the dip. So why I'm saying buy in the dip? Because you never, and nobody ever in the world, not even Warren Buffett, can time the market. And Warren Buffett has a very interesting quote. He actually saying it's not about the about timing the market, it's about time in the market. What he actually means is that you should be as long as possible in the market, and this coming now to the next short video that I want to put into this vlog. And you can see in this animation, it's showing you the profit and loss if you're looking into investing during 1 year into the S&P, or 5 years, or 10 years, or 20 years. So you see how it develops. If you just invest into the first year and take your money out and in and out for 1 year only and take it year by year, you have sometimes 20% loss, 5% gain, 20% loss, 10%, 30% gain, and so on and so forth. But if you're looking into the long term, like 5 years or 10 years, you see that almost over 20 years you don't have any lost money at all. And this is the power of long term, because, you know, if you are having a long term, and we have seen the bull market is very, very strong and very, very long, that means the bull market, long positive periods of the market, the years of positive gains and so on, like for example since 2007, 2009, the financial crisis, we have a huge bull market going on since now over 10 years. So if we have now half a year, or let's say 10 months, 12 months, a recession or a downturn, you know, it doesn't matter, because then maybe we have the next 10 years of a bull market. So it's important to stay in the market, and just if you have cash on side, I believe it's a good opportunity to buy these dips, not only this week but over the next couple of months. As you know, you cannot time the market, and how you do it, this is number 3 on the list, which we dive into a second. Top number 3 things to do when going into a recession. If you really insist to sell to build up your cash position, or if you insist to buy in the dip, do a dollar averaging method. What does it mean? This means that actually you are buying every month. So as I said, nobody can time the market. So it's important that you over time buying over, let's say every month when you get your salary, put something on side that you want to invest and put it into the market. So, you know, one day you have the stock at $5, then you have it at $10, that you have it at $15, then you could have it at $5 again, and $3 and so on. So if you're thinking maybe that, you know, $15 is great, but the next month the stock will be at $10, you will lose a lot, because you put everything at one moment into the market. But if you're putting it in different kind of periods of time, then you have the chance to have the best price for the stock, for the index, during an average of time. And that's why this is what you should do. Now have a look into some other videos that I put together. Here you can see that the recession, the yield curve, which triggered this market sell-off just recently, is going down during recessions. Over time you see like a parallel movement that, you know, months to the recession, the yield goes negative and so on. So this is what's happening now. Also, what you will see is actually that the most stock negative pain is actually the first 6 months to the recession. So actually, as I said before, and if you saw the video before, the recession gains are actually positive if you're looking average over the last couple of years and decades. But the first or the last 6 months when we entered the recession, this is where the market loses the most. This you see in this video. And another good news is, it seems like if we're looking now into this, the next snippet is that actually it seems that over the years the recovery time in case of a market crash is less and less. Like if we're looking into the 50s and 30s, the recovery time from the market price going down and go up again could be even 25 years, 16 years. And the recovery time from, let's say, dot-com bubble to the next financial crisis or and so on was only 6 years. So this was very, very important. You see that the market recovering much faster if you're considering the last couple of decades. So this is a good news also to stay in the market. And also don't forget, this opportunities to go down is a great opportunity, because I explained this already in one of my other vlogs. It's very, very important. The turnaround could be your best option ever to buy stocks or anything else, because if a stock goes down from $10 to $2, it's 80% loss, okay? But let's say you buy on the downwards to this $2 and your average is, let's say, $4. Now, if you go from $4 back to, or let's say you go from $2 back to $10 and bought a lot at $2 and $4 and so on, that's 500% gain, and the stock just is on the same level before the recession, before the depression, before the crash. So this is the beauty of stock market investing and dollar averaging on the way down. And I think that's a wrap. I mean, this is the top 3 things that you need to know. Let me know what you think about the recession. Is it really coming? What you are doing? Are you investing in something else? Do you have other tips? Let me know so I can implement it to the next vlogs. And smash the thumbs up button and subscribe if you are new. Don't forget, the grass is greener on the other side. Thank you. Peace.